Welcome to the Scale Up Valley podcast, where we bring the best founders and investors to help you scale a business from 1 million to 1 trillion. Today's guest is a very special one. We have been trying to do this episode for a very long time now. And his name is Daniel, the partner at Speedinvest. Daniel, welcome to the show.
Yeah, thanks, Mike, for the invitation. Hello, everyone. Looking very much forward to this.
And for the ones who didn't have the opportunity to meet you, you joined and you started Speedinvest in 2011, so almost 12 years ago, this June 23, so which is really the beginning of the European ecosystem of VC. And you are based in Vienna, in Austria, which is even more interesting to understand how it all started. So if you could just share a bit about your background, your story, and how did you end joining Speedinvest?
Yeah, happy to do so. Yeah, that is actually correct. So again, hello everyone. Greetings from beautiful Vienna.
Absolutely.
Yeah, we actually started Speedinvest before 2011 already. 2011 is the formal vintage date of our first fund. So normally it takes about a year or maybe even more to set up a fund. So the work in the dark on this started in summer 2009, actually. We were sketching out the idea and laying out the plan and starting over again and throwing the plan away and restarting again. And this was, as most probably here will remember, in the midst of the global financial crisis. So capital markets on fire all around. And we had no better idea than launching a high-risk, highly illiquid niche product out of a geo that has no justification on private.
Great timing.
Yeah. Well, in the first moment, we didn't think of timing. It just felt the right thing to do back then. 3 years after we have sold our first tech company, the earnout and lockup period was over. In the beginning of 2009, that was 3 years after the sale. We didn't look up or look left and right. Of course, we took the news that Lehman went up in flames and everything is going south and markets collapsing all over. Every morning the news broke, Dow down 10% again, and that went on for 5 days in a row. We took notice, but we didn't put it into context with our own plans. Now, in hindsight, it was actually good timing because valuations came down also, and history tells that the best opportunities and the best companies are created in the most turbulent of times. No idea had we that for the next 10, 12, 13 years, turmoil like this or even worse would be here with in a 5-year schedule. 2014, 15, Euro debt crisis. We brought our second fund. 2020, another 5 years in. Brought our third fund, and everybody knows what happened in March 2020, and it's not stopping. And almost a year later, after pandemic breakout, the raid on the Capitol in Washington. A year later, the invasion in Ukraine. So it's not stopping. It's not stopping. Exactly. So you cannot time markets. Particularly not private markets, and for sure not venture capital and pre-seed seed stage markets. Not timeable.
Right. Great lesson to learn. And let's start with today. What is the Speedinvest investment thesis today? And then we'll go a little bit through the evolution. Where did you start and where are you going now?
Yeah, evolution is probably a very good word to encapsulate. Investment thesis over time also did in Speedinvest, they evolve, right? You start out with something that you think you know. In our case, that was enterprise B2B mobile telecom SaaS, because this was the core of the business model of the company that we sold 3 years before. Very signed, Nasdaq listed. So we started, you know, on a playing field. We thought we knew somehow, and then eventually you grow. You touch into fields you have no idea. Very early on, even in the first fund already, we invested across 3 topics: fintech, marketplaces, and SaaS. And they still now, 12 years after, they built the core of our portfolio.
Got it.
We kept adding new topics, for example, climate and industrial tech, digital health, deep tech, and also new geographies. Already back then in 2011, we invested in our first market outside of Europe, that was Turkey.
Awesome.
And the investment was extremely successful. Trade sale, only like 4 or 5 years after, a double figure multiple. So that, you know, that sets the mindset and also the hopes and expectations. So that got us very early on the track to look into geos further abroad than only neighboring countries or the home continent, because it's our very, very strong belief that good talent grows everywhere. They only need to be given the right, or put into the right habitat, and given the necessary means to really seize the opportunity ahead of them and capture their full potential.
Right. And in terms of emerging markets, where are you investing now, Daniel?
Predominantly Africa and Middle East, Southeast Asia, and Latin.
Got it. So super clear. And in terms of any founder that is out there, and in terms of stage, I think this is important. You are a seed stage investor, right?
Yeah, we start in seed. To us, seed means the first, say, funding round where institutional VCs take part. That's typically a funding round in the size of single-figure million, where we would ideally take the lead in such a round. We typically would not invest as a first ticket in a Series A, because we are declared seed investor. We've done this for 12 years now. Now moving up or further downstream rather, that would mean going back in the learning curve and not capitalizing on the 12-year plus experience set that we've built up.
Right. And in terms of seed, you also invest in pre-seed or as well?
We also, so core is seed. Seed means to us, as said, first fund on the cap table. Tickets in the range of $500,000 to 2.5-ish at corresponding valuations that would allow us a 15% stake. Occasionally we go earlier. Pre-seed tickets 2 to 500K. Not so strict on stake, but just to be part of something that we think might be something very exciting. The range is fairly broad. In the current fund now, late 22, early 23, an average ticket is in the range of 1 to 1.5 million approximately.
Got it. So of course your journey has been a long journey now. So you were able to exit a company as an operator and being in the VC industry for a long time. But why should a founder look for Speedinvest as partners on their VC route or VC path?
I think it's just as important as for a VC to have an investment thesis and areas that and build expertise on and really have value at beyond the dollar that you invest. Vice versa, it's just as important for the founder to know which fund to choose to work with. And
Right.
this is important across all stages. But the things to look for in a fund for a founder, that changes from, say, to one extreme pre-seed to the other extreme pre-IPO late growth. I'd say in the early half of such a typical journey, say pre-seed seed A/B, operational value add, non-dollar value add is just as important for to make or to make a founder choose a fund A or over a fund B.
Right.
And well, when it, now looking at us, we focus on 6 topics. That is 4 verticals: fintech, climate and industrial tech, deep tech, and digital health. And on 2 horizontal approaches that go by 2 software-specific business models. One would be SaaS, and the other one would be network effects or marketplaces. So that builds a 4x2 matrix of 8 hotspots, along which we probably would deploy in 90 to 95% of the fund's capital. And these are in these sectors, we have specialist investment teams that only do deal flow in their sector.
Wow,
So
super specialized.
Super specialized. In a way, if you will, Speedinvest is not one fund, but it's like 6 specialist funds bundled together. So more or less a fund of fund at the cost of a direct fund.
Got it. Wow, that is amazing.
And each of the 6 sectors is covered by a specialist investment team in the range of 4 to 10 people. Each of the teams have written their abstract thesis on their respective sectors with a 2, 3, 5, 8-year time horizon to really build an idea of what that industry or that business model can look like in 3, 5, 8 years time. What will be the driving, the dominating technology, the cost drivers, the value drivers? Is there any change of target group / client or consumer behavior to be expected, and how would that look like? And that built on the large mega trends that built the foundation for the whole tech ecosystem, like digital transformation of economy and society, demographics, education, healthcare, energy transition, decarbonization, democratization as well. When you peek into direction of Web3 and decentralized concepts, and having written such a thesis, our investment teams know a promising startup when they see one. So we process in the range of 8 to 11,000 opportunities every single year. And we pick probably 30 for an initial investment.
Just for the ones who are out there. It's always important to remember those numbers. It doesn't mean that you are not a good startup again and a good founder. It's just a numbers game, right?
It is a numbers game. To lay out the odds, 30 out of maybe 9 to 10,000 make it into our portfolio. So that is already less than 1%.
Exactly.
And
then the percentage that
the teams can take a quick and informed decision because they have their idea, and if they come across a founder team who come across legit and experienced and deep into the subject, our team can quickly decide and take a quick and informed decision, and then spend off that limited time that one has to do a due diligence on a seed stage company. They can spend relatively the most time on liaising and building a resonance with the founder and see if also that clicks on a personal level, if chemistry works, That is in fact important. It's not the only thing, but overall, probably team is actually the relatively most important part of the assessment.
Right. This makes a lot of sense because speed is so important at any time, but especially on those initial times. It can also mean the death of the company. That it's super important to know very quickly if it is a yes or a no or a pass, whatever it is, and if possible with feedback attached. It helps so much the founders.
Absolutely. I said we look at up to 10,000, we pick 30. So in 99.7% of time, we say no.
Right.
As a result, of course, the no answer must be the one that is elaborate. The yes answer is easy. Is easy given at least. Of course, we need to be very careful who to say yes to, but also in our business, specifically in seed stage, the false negatives can be so much more costly than the false positives.
Right.
So it's a very, how to say, interesting and peculiar area of investment that a seed stage fund operates in.
That's really amazing how quickly you need to be able to get a sense if that team really is the right one to execute on that opportunity, and if they really get the vertical or the opportunity that they are attacking, and if they have a long-term vision for that, right? So and then you evolve it, and you just mentioned the example of Turkey to emerging markets. Why emerging markets and why get out of Europe? You already have enough complexity in terms of, as you said, the two business models plus the four verticals, your matrix, you are specializing your team. So getting out to emerging markets requires another extra layer of effort, but opportunity as well in any expansion strategy. Right?
I mean, as said, we did our first, say, how to frame this, promising market, fringe market of Europe in Turkey already 12 years ago. So we very early on got in touch with these geographies, and that slowly, gradually built over time. So by now we have nearly 20 investments in what we call emerging markets or undercapitalized markets. And we
20 out of Daniel?
Historically, probably 350.
Got it.
And we, at least for the time being, restrict ourselves to fintech and marketplaces. So these are our two strongest topics where we have the deepest sector understanding and the strongest reputation. And this allows us to also win deals in not the most immediate home markets. Right. Then why emerging markets? I mean, start with the math. It's so simple, right? 5 billion people living in those countries. If you include India, 5 billion people living there. By a rough guess, 80% has internet or a cell phone, and probably 40 to 50% have a bank account. Yeah, pitch done, right?
Yeah.
And then combine this with our strong belief that good talent grows everywhere, and we think it's actually normally distributed around the globe. Only over time they gravitate towards some metropoles or hotspots, but basically it's I think it's fair and right to assume that the talent is evenly spread across mankind.
Yeah.
And not investing there would be simply a massive omitting of opportunity.
Yeah.
So in just yesterday or a few days, I heard over the radio there is being elections are being held in Nigeria, and half of the country's population is younger than 19.
Wow.
I mean, these are textbook population pyramids, right? They look like this, yeah,
exactly.
not like this like in Europe or probably North America.
Exactly.
And these are, you know, growing societies, growing economies, of course, with all the challenges. But we think, and specifically in fintech, that you know, giving these people democratized access to at least the most basic financial products and services is a prerequisite for the path out of poverty. It's not the only thing. The other large thing is, of course, education, and we're working on that one as well. But we are not as far advanced as in fintech. But giving democratized access to elementary financial services, a checking account, right? Get them off cash payments and pencil and paper bookkeeping. Giving them the necessary tools in hand to empower them to manage their financial lives. And you can only improve what you can manage.
Exactly.
And that all combined is, you know, that points to an opportunity that is just too big.
Yeah. But that's interesting, the way you are adding. I think this is also very interesting for any operator and for any company, the same perspective, the way you are leading your VC investment thesis, which is you might be adding another layer of complexity in terms of geography, but you didn't add all the verticals and all the business models to those new geographies. So you are starting with a very specific focus on those new geos, right?
Also, as you know, running and managing a fund, you need to try to scale. And for now, restricting ourselves to those topics where we have the strongest reputation, the largest teams, where we have the biggest leverage. Also, that is to the best benefit of the founders that we work with.
Right. Absolutely. And something interesting is we know that Southeast Asia is in another stage compared to Latin, Middle East, Africa. I would risk to say that Southeast Asia is definitely the most advanced on those four regions. We see Latin catching up. We see also a lot of movement in Middle East, Africa. I don't know so well, but as you have a more global perspective on emerging markets, what are some of your thoughts on how the different ecosystems are evolving?
The dynamics are somewhat similar across all the regions. Of course, yes, every single country, every wider region has its own specifics and if you will, its own personality, you know, culture, history they've gone through. So in a way, yes, there is some common denominators across those, Latin, Africa, Middle East, and Southeast Asia, but then again, no, right? So for example, out of the named regions, we see more opportunity in some and maybe less in others. We do take a differentiated look at every single country. Then, of course, we venture capital itself, it also, you know, comes with its own requirements. We have our own business model to fulfill. We have our own promises to keep towards our LPs, and that goes. It also depends on the size of the fund you're investing from, what kind of deals you can do that actually help you reach your target and fulfill your promises. So a deal which is great for a 50 million fund might be a pass for a 200 million fund, because it simply does not have the mid to long-term scaling potential to become a large enough and valuable enough company to help returning the fund. Both business models, they might be of the same entrepreneurial quality, and not one is better than the other. It's just one is a fit for Fund A and the other is a fit for Fund B.
Got it.
I think that it's super important to make this point, because we often end up having to pass on proposals which we actually we would like, but we cannot build the conviction that mid to long term this can transfer into a company large enough that helps us returning our fund.
Right.
In such cases, we would help the founder or point him to other funds that we know are active in the regions, who come with a different requirement, and who might be the right fit.
Yeah,
and that's one of the very important specifics of private markets compared to public markets. It's always both sides of the deal need to agree to it, right?
Right. And you just added an important topic, which is, of course, you need to have an investment thesis to be able to focus all your activity, and also to select the best teams that can win and return the fund. And you also have another audience that you need to serve, which are your LPs. So you also need to do fundraising in order to raise funds from your LPs, because you have an investment thesis that makes sense as a founder, as an investment thesis or a deck that makes sense for the VC to invest in him or in her. So any topics or any comments around that process? I know that you are both involved in fundraising from LPs and also in the VC activity of Speedinvest. Any comments or any tips there from your experience raising money from LPs? Or what is your value proposition for them? Maybe that's a better question.
I mean, I think it's there is a fundamental difference between a fund manager raises capital from LPs towards a startup raises capital from a fund, right? And specifically in seed stage, by all data and statistics, we know that about half or even more of the initially funded companies will eventually not make it, right?
And 50% is a great percentage.
But this was just I was trying to pull some numbers from the back of my head. This it varies a lot from very seed stage. Maybe the quota is way higher than 50%. Of companies that will eventually fail or not work out towards, and then for a fund manager to still invest in such companies, because by the moment of investment the fund is convinced that this can work out. And then again, by data we know it won't. So it is okay. I always say it's okay for a fund manager to lose a part of its money, but it's absolutely forbidden for an LP to lose money on a fund. Right, and these two parts of the market, and the fund is in a very interesting position in this market. On the one hand, we have this very, very high velocity, high rev startup market. And on the other end, we have this very slowly moving, low rev LP market. And the fund is kind of the gearbox in the middle that needs to transmit from the one side to the other, and from the other side to back again to the first. So raising capital here from this, that slowly moving LP market, investing it in the fast moving startup market. Returning it from this startup market, fast-moving startup market, into this slow-moving LP market.
Right.
And in the startup market, we have typically, cadence or frequencies of funding rounds of, in the peak of the 21 market, it was probably a year or even less, from A to C to A to B to C to D. That is expanding a bit now. On the LP side of things, that is that 3 to 5 year fund cycle. Yeah.
Right. Completely different. Yeah.
So to raise for a fund manager to raise capital from investors into a fund is so I mean, we've done it multiple times now. I think overall in those 12 years we raised more than 10 funds in various
Incredible.
sizes, from 10 to 300 million. Well, it might sound paradox, but the first fund is not the hardest to raise.
Maybe the second, right?
Well, if not the third, because the first fund, if you have something to build on, right? A target group, an audience that you can convince with a credible story, given maybe by your own entrepreneurial history, or you've worked with another fund before, you come with some kind of track record and pedigree and DNA that makes you credible for the story that you tell. The second fund, 3 years after that, maybe, specifically in seed stage, a portfolio can by no means be as far to already produce returns. The second fund, you still might tell on the story, but by the third fund, the first fund at least needs to produce results.
Right.
So you can make it.
I understand it. Yeah.
Provided you manage to raise fund number one, you will well, there's a fair chance you might raise fund number two, but at latest by fund number three, you need to bring proof, that you also need to plan when raising fund number one. You would never raise just one fund. This cannot be the plan, right?
Right.
You need to always plan one or maybe even two funds in advance. It's the same that we tell our founders. If you raise a round now, always have the round after that and the consecutive round in mind. How does your cap table look like? Who do you want to have in? And plan from the future into the present, and build your fundraising, set your fundraising goal and build the campaign in a way that creates the best chances to raise the next round and the round after next.
Yeah. From a mindset perspective, it is very challenging because it takes, as I hear a lot of investors tell me, a long time to see if you are good or not at what you do, right?
It all comes down to communication.
Why?
As said, first you need to craft a story, then you need to tell a story, and not in a way. You need to tell it in a way that the addressee understands, that he gets the message.
Yeah.
Never think from inside out, always think from outside in.
Right. Think about your audience first, right? So
about the audience first, make
understand how they think, what are their priorities.
To understand you.
Yeah.
Speak their language, not yours. And do not, stubbornly stick to the narrative. Address their questions. So yeah, communication is probably maybe more important than many people would think.
Amazing. Great reflection. And before going to the last segment of the show, Daniel, of course, I'm sure that the ones listening to the show would be super curious to get some of your lessons learned from the portfolio. So do you see any patterns of the teams that succeed, of the companies that are successful? If you would need to kind of find out 2 or 3 patterns that you see that separate the ones who succeed from the ones who don't succeed in your portfolio of 350 companies over the last 12 years, what would you say?
Well, and this might be a really personal observation. Again, do not underestimate the importance of communication. If one can communicate, it makes easier, to sell your product, makes it easier to raise the necessary capital, makes it easier to hire the right people. Also, when times get harder, the ability to communicate is probably one of the most important leadership tools.
Right.
Any pattern? I mean, we saw a lot of things that are counter textbook, like we invested in couples and it worked out. We invested in brothers, it worked out. We invested in another pair of brothers, it did not work out. We do see a tendency that serial founders have a higher chance of success than first timers. But then again, we see first timers come out with a triple figure exit success.
Right. It's really difficult to find the patterns, right? Long story short.
Well, there is some data, but it's not the proof. I'd say it's some indication, some weak indication, and by the sheer size of if our portfolio continues to grow, and we're looking forward to add 100 new companies with each single fund that we bring to the market. So by the end of this fund, we will be north of 400 investments. Next fund probably 500, and then I think the data sets also. But then do not forget that spans over 15 years of time, right? And
the criteria for success
change.
Yeah.
A founder now is not to the average founder now, not to be compared with the average founder 10 years ago. Right. So there is development and progress in that so important founder ecosystem as well. They get more sophisticated. They get more ambitious. They get more thorough in working. I mean, we've been founders ourselves 20 years back. I mean,
don't say that in that way. just some time ago.
I mean, see, the average founder now is times better than we were back then.
This is very humble coming from you, so it's very beautiful to hear, and it's also good to see that the ecosystem is evolving and we are getting better and better.
Yeah, that makes me very, very confident on the ecosystem itself, on the asset class. Very, very confident.
Especially both in Europe and the emerging markets, and in all markets, we are seeing second, fourth, fifth generations.
Also, America is not moving backwards.
Yeah.
I think, again, very, very confident for what is to come.
Amazing. And going to the last segment of the show, we will just do here a quick ping pong of quick questions and answers. So if you would have the opportunity to have a coffee with Daniel in the summer of maybe not 2011, because you started in 2009 to raise the fund, what advice would you offer to your younger self?
To my younger self, yeah, that's probably influenced a bit by the work that I most recently focus on in our companies. Try to understand your investors better. They are actually, in the end, the source of all capital that is being deployed through GPs. And the better you understand them and their needs and expectations, and the easier we could have raised more money if we had better understood how they work or how to access them.
Understand better your customer, in other words.
In a way, yes, of course, yeah.
Good point. What are you the most proud of on your journey so far?
On the professional journey, well, it's probably back then having taken the leap out of banking into the tech ecosystem and despite having raised the seed round in March 2000, still sticking with it and bringing the company to success, and then starting all over again with creating Speedinvest. I think that is something I would do again.
Awesome. Worst advice ever received?
Worst advice ever received? Oof, good question. I don't know. Honestly, I have a hard time picking
Exactly.
one.
You forget those very quickly.
Yeah, that seems to be a built-in protection mechanism to human mentality, to over time blind out. You know, in short-term memory, in a way, the bad experiences they are very present, but the longer away they are, the stronger they fade out.
Yeah.
Worst advice. No, sorry.
No worries. I'm seeing that trait. There are people that would say, and we see that kind of personality in founders, operators, and investors that succeed, that they want to prove someone wrong, but at the same time, we also have the ones who don't really care about what other people think, and they just forget. And you get what I mean. Of course, they listen, they are humble, but yeah, they will take what serves them, and they will block out what is not useful. So, good point. And finally, just the resources. Favorite book, business or non-business, anyone that has impacted you on your lifetime?
Favorite book. I don't know. The unfortunate
ring a bell.
You at least I myself, I don't manage to read that many books, unfortunately, because it's, you know, the days filled with reports and newsletters. But one I actually very recently read, that was like last summer or so, was Scott Galloway, Post-Corona. What I like particularly is that he takes you know, very surprising looks on things, and comes up with very, you know, surprising interpretations or you know, ways to view things. And I think to a venture capitalist, specifically in seed stage, I think that is something important, to think unconventionally, think out of the box. Right. Just few things differently than the rest of the market does. Not necessarily taking contrarian positions, but in many times your worst competitor is not from your industry.
Exactly.
Your worst competitor is not from your industry. Some is in some cases not from your industry. By only monitoring your closest market environment, you might overlook large opportunities or really endangering threats. Exactly.
Great addition to the list. Favorite movie or series, as you wish?
Again, besides news and live sports broadcast, I don't get to watch that many.
That's great.
TV. Maybe to point out my last visit to a cinema, that was nearly 3 years ago. And this was only for a reason, because the film was made by someone I know.
Okay.
Prior to that, it's been 5 years that I haven't set foot into a cinema. Yeah, you know, combination of, you know, the surge of streaming and Netflix and all those, exactly, plus then the lockdown. That's a business. Or in the times before, I had, like, you know, once a month, twice a month, went to the cinema. So, and now just not. But I did not replace it with something else. Not that I would go sit at home and binge watch Netflix for a night or a weekend. No, I don't.
Yeah, you don't.
Just scratched off the list and not been replaced.
And finally, your favorite podcast, excluding this one.
Well, there's a ton of good stuff out there. I mean, obviously, specifically in Europe, 20VC of Harry Stebbings is definitely something
great one
that produces good good stuff to listen into. Yeah, of course,
that's great.
Definitely. One thing I sometimes, if I happen to have the time, listen into is tech news around the world.
Okay.
But that's not kind of a hot. It's more like a daily talk radio show around this time of day, so late afternoon CET. You know, it's a group of 3, 4, 5 people, mostly the same, plus adding one guest member sporadically, and they just comment the daily news headlines in tech. Go through some Twitter feeds and just spontaneously comment on that. And there is, you know, it's a good way to catch up the things out there that are beyond your daily radar.
Difficult to cover everything nowadays. There is so much information.
Difficult to catch. I actually really try to stay clear of Twitter.
I've decided to double down on LinkedIn for a long time ago. I don't go to any other social media. I was exhausted of trying to be everywhere. So
I do Instagram a bit just to see nice pictures. You know, from my skiing friends posting POV powder videos,
personal side,
to make me jealous while I sit in the office.
Exactly. Sounds amazing. Daniel, it has been such a pleasure to have you on the show. Thanks so much for making the time, and you are always invited to come back to share the next chapters of your journey. Thanks again.
Thanks, Mike. All the best.
And to our community, thanks for being there. We keep bringing you the best of the best to make your life a little bit easier as you scale up your business. See you soon and keep scaling.